Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and risk management. I'm your host, Lewis, and we're glad you're joining us today. We've got a big story to kick off the show as news is breaking that Warren Buffett, the legendary investor and CEO of Berkshire Hathaway, has announced his intention to step aside by the end of the year. This move has sent shockwaves through the financial world, with many wondering what it means for the future of Berkshire Hathaway and its investors. Buffett, known for his value investing philosophy and impressive track record, has been at the helm of Berkshire for over 5 decades. His decision to step down marks the end of an era, and many are left wondering who will fill his shoes. According to reports, Buffett has recommended Greg Abel, the company's vice chairman for non-insurance operations, as his successor. Abel has been with Berkshire for over 2 decades and has a deep understanding of the company's operations and culture. However, some investors may be concerned about the transition and how it will impact the company's investment strategy and overall performance. We'll be exploring this story in more detail throughout the show, including what it means for Berkshire Hathaway's stock price and the broader market. We'll also be discussing the implications of Buffett's decision on the world of finance and investing. It's worth noting that Buffett's announcement has been met with a mix of emotions, from sadness to optimism. Some see this as an opportunity for new leadership and fresh perspectives, while others are concerned about the potential disruption to Berkshire's successful formula. As we delve into this story, we'll be speaking with experts and analysts to get their take on what this means for investors and the market. We'll also be examining the potential risks and opportunities that arise from this transition. So stay tuned as we navigate the complexities of this major development in the world of finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, folks. We're diving into the world of closed-end funds and exchange-traded funds in this segment. Our first story takes us to the Herzfeld Caribbean Basin Fund, ticker symbol CUBA, which has been making waves with its unique holdings and deep discount. Currently trading at a discount of around 36%, this fund offers diversification with some unusual names that don't always make it into other funds. Now, I know what you're thinking, Louis. Why should I care about a fund with a deep discount? Well, my friends, the answer lies in its performance. Despite broader market volatility, CUBA's concentration in Mag 7 names has helped its performance hold up relatively well. And let's not forget its attractive distribution yield of 8.08%, which is boosted by the discount. But here's the thing, this yield is primarily funded through capital gains, with a manageable NAV distribution rate of 5.22%. So, it's essential to keep an eye on the fund's underlying assets and governance structure to ensure that this yield is sustainable in the long term. Moving on to our second story, we have Bexil Investment Trust, another closed-end fund trading at a deep discount of around 36%. This fund offers diversification with some unusual holdings, which can add value to investors' portfolios. Its performance has been relatively stable, thanks to its value-oriented holdings and concentration in Mag 7 names. Now, I want to emphasize that investing in CEFs and ETFs requires careful consideration of various factors, including governance structure, underlying assets, and distribution rates. It's crucial to do your research and consult with financial experts before making any investment decisions. As we navigate the complex world of CEFs and ETFs, it's essential to stay informed and up-to-date on market trends and analysis. Our friends at Seeking Alpha have been doing an excellent job of providing in-depth coverage of these funds, and I encourage you to check out their articles for more information. In conclusion, when it comes to investing in CEFs and ETFs, it's all about finding the right balance between yield, risk, and governance. Remember to always do your due diligence and consult with financial experts before making any investment decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to shift our focus to the world of dividend investing. Now, I know some of you might be thinking, dividend stocks? That's a snooze fest. But bear with me, folks, because we're about to dive into some fascinating territory. Recently, I came across an analysis of the Sound Equity Dividend Income ETF by the Sunday Investor. Now, this actively managed fund aims to provide a dividend yield at least twice that of the S&P 500 index. Sounds enticing, right? However, as the Sunday Investor points out, Divi's yield and valuation metrics might be strong, but its performance has been below average since its launch. So, what's behind this underwhelming performance? According to the Sunday Investor's fundamental analysis, it's likely due to the poor quality and growth of the stocks within the fund. Low earnings growth and profit margins can limit dividend growth and protection in market downturn. Now, I'm not here to bash Divi or its management, but rather to highlight the importance of looking beyond the surface level when evaluating investment opportunities. On a related note, I'd like to mention another article that caught my attention: Top 50 High-Quality Dividend Stocks for May 2025 by Dividend Yield Theorist. This author has been tracking an investable universe of 50 high-quality dividend growth stocks and updates valuation ratings daily to identify attractive opportunities. What I find intriguing about this approach is the focus on high-quality businesses with strong track records, attractive valuations, and desirable future rates of return. It's a reminder that dividend investing isn't just about chasing yield. It's about building a portfolio that can withstand market fluctuations and provide long-term growth. As we conclude today's show, I want to leave you with a few takeaways. First, when evaluating dividend stocks or ETFs, make sure to dig deeper than just the yield or valuation metrics. Consider the underlying quality of the businesses and their potential for growth. Second, don't be afraid to think critically about the investment opportunities that come your way. And finally, always keep in mind that investing is a marathon, not a sprint. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.